From time to time, people will walk in here with an investment portfolio holding single stocks or individual companies. Well, what are some of the potential problems here? Well, let's take a look at the Dow list in 1976. These are 30 companies that are typically seen as representative of the U.S. economy, according to the Wall Street Journal. Well, how many of these companies are still in the Dow list today? Only 5 of them, and 2 have had name changes. The other companies, well, maybe they haven't performed quite up to par over that period of time and they were removed from the list. Now, 4 out of 5 of these surviving companies have actually underperformed the Dow over that period of time that we have data. So we see that there's a problem here in holding single stocks. Now, what's going on here? If we look back in 1965, the average tenure of companies in the S&P 500, the 500 biggest companies, was a full 33 years. They stayed in the list. By 1990, it was down to 20 years, and now it's forecasted to shrink to just 14 years by 2026. Companies are coming and going out of these lists much more rapidly today, and part of it's because of global competition. Now, another problem with holding single stocks is this. Look at that light blue line on the top. That's the entire S&P 500 list. If I held that list of 500 biggest companies, this is one of the survivors in that list of Dow companies, and you notice something, a lot more volatility, and in this case, lower returns. So sometimes what happens is we take risk of holding single companies and we don't get compensated for taking that risk. Now, why do people hold single stocks? Well, a lot of times it's because they think they know something about a company that will give them an edge or give them higher returns. And they think, well, I'm taking more risk. I ought to be rewarded for that. Well, that's an assumption that there's a mispricing in the stock, that they're buying something that's selling for this, that I know it's really worth this company. I've got information that can give me that edge. Well, let's take a look at a totally different world. Jelly beans. Guess how many jelly beans are in the jar? Well, that was this game right here played in a study. And what they found is that people guessed when they were looking at the jar that there was anywhere from 400 jelly beans in there to 5,300. On average, the average guess was that there were 1,600. How many were actually there? About 1,600. So in aggregate, people are pretty good at guessing how many jelly beans are in the jar. But they're also really good in aggregate at figuring out the proper price for a stock. So anytime you're buying a single company, you don't have an edge really when it gets down to it over the entire market, and chances are you're taking a whole lot more risk than you may realize.